Well, after a rough ride in the press for the last 2 months, the Walt Disney Company unveiled their fiscal quarter 2 earnings report on Wednesday, May 11th. And they came in with a few surprises, some good and some bad, some industry analyst expectations being exceeded and others not being met. We're going to talk about those and what they mean now and going forward. And we also want to debunk some of the information that's going around from a variety of places on the internet as to why the Disney stock price is in the position that it's in. This is what we do here at Valiant Renegade. This is all fact-based discussion based on financial metrics and business metrics. And if that's what you're looking for, well, you've come to the right place. Let's get into it. Renegade Online. Well, welcome back. Another great day here at Valiant Renegade. It's great to see everybody out there once again. And if you are like one of the many folks out there watching this video right now that are not yet subscribed to this channel, please do me a favor. Take a moment, hit that like button, hit that subscribe button, hit that notification bell, share this sucker out on the social medias, and of course, do leave a comment below the video before you head out the door today. YouTube loves the comments. I love the comments. I try to respond to as many of them as I possibly can, and I promise I'll try to get to yours if I can do it. So let's talk about first some of the expectations of what would come out of this Disney report and what actually happened. Let's talk about the key metrics that analysts and investors tend to look at for this. And for that, let's look at a recent article from IBD, that's Investors Business Daily, that gives us a good, concise breakdown. Disney earnings. The estimates that analysts polled by FactSet expected Disney earnings to jump 50% year over year to $1.19 per share. That's earnings per share. Revenue was forecast as rebounding 28% year over year to $20.061 billion total revenue for fiscal quarter 2. Analysts also expected to see Disney Plus subscribers reaching 135 million in fiscal quarter 2, up by more than 5 million from fiscal quarter 1's 129.8 million subscribers. The actual results, however, Disney earnings rose by only 37% to $1.08 earnings per share, missing the analyst estimates. Revenue climbed 23% instead of 28%, landing at $19.249 billion, also falling short. However, Disney Plus subscribers surprisingly climbed to 137.7 million in fiscal quarter 2, a gain of almost 8 million from fiscal quarter 1. The subscriber count across all of Disney's streaming channels, which includes ESPN Plus and Hulu, reached a total of 205 million subs. Theme park revenue more than doubled year over year. Fiscal quarter 2 of 2021 to fiscal quarter 2 of 2022 rose to $6.65 billion. Revenue rose 9% in the media and entertainment segment, including 23% for DTC, that's direct-to-consumer streaming services, or in other words, mostly Disney+. But streaming or DTC losses also increased in Q2 with the build-out of Disney Plus and ESPN Plus, both weighing on results. Disney said that it would boost content costs by $900 million in fiscal Q3 versus fiscal Q3 in 2021 a year ago. So let's take those two biggest segments for the Walt Disney Company, the biggest of which, and for probably the foreseeable future, will be the Parks and Experiences division, the theme parks, Disneyland, Walt Disney World, all the international parks that Disney has under its belt. That is still the cash cow for the Walt Disney Company. And of course, as we come into the summer months, most folks out there would expect that these revenues to increase sharply even over this quarter that they just reported. Now, Disney still had a very good Q2 for the theme park business, certainly much better than Q2 in 2021, but that's to be expected for obvious reasons. In 2021, still most of the parks were locked down. Now, in Q2 of this year, there still are parks like Shanghai Disney that still are under heavy restriction or have been locked down entirely. That certainly is having an impact on the bottom line. As time goes on, that will probably release, and that park will be able to reopen to at least some capacity at first before it reaches full capacity once again. But let's talk about those theme parks. What happens in the summertime? Families pack up, they go on vacation, and a lot of those families wind up going to Walt Disney World. That is still the biggest of the theme parks, much, much bigger than Disneyland, both in terms of geographic size and in terms of total revenues and operating income. Disney World, Walt Disney World in Orlando, is where the money is for the Walt Disney Company, and they need that cash cow to keep mooing. Now, one of the things that Walt Disney always counts on, especially in the summer months, is international travelers. We know factually from Disney and from basic common sense that international travelers spend far more money than domestic travelers do. If we take domestic travelers and we lump them all in one bucket, compare them to international travelers, those international travelers spend scores more money, especially if you take out the local residents in Florida that typically just go into a Disney park, do what they want to do, and then leave without buying too much additional merchandise. Domestic travelers that come in from other areas of the country tend to spend more than those in Florida. And of course, international travelers spend even more than those. So in the last few months, we have covered a lot of news on Walt Disney and what they have done as far as going quote unquote woke. All the stuff that we've covered regarding their opposition to Florida House Bill 1557, the Parental Rights and Education Bill, all of the terrible negative press that caused them from both sides of everywhere. And a lot of people out there were thinking, well, this is going to really injure Disney. This is going to hurt their bottom line. Well, for right now, that hasn't happened yet. And I want to have everybody try to remember for a second that this earnings report only ran up through March 30th of 2022, okay? All that stuff with Disney started in mid-March of 2022. So there was only about 2 weeks in this measured fiscal quarter that could have had any sort of impact. And as far as we can tell from this report, it had virtually no impact whatsoever. If folks are deciding to not go to Disney theme parks, if folks are deciding not to renew their Disney Plus subscriptions, it really would not have shown up yet. If it's happening right now, and we would ostensibly then see that reflected potentially in the Q3 earnings report that we would expect at this point sometime in the early to mid part of August of this year. But let's move on to Disney Plus, because this is where the focus has been. The moment Robert Iger announced some 3 or 4 years ago that the Walt Disney Company would be moving into the streaming game, that changed the entire dynamic of how industry analysts and investors viewed the Walt Disney Company's stock and how they viewed that corporate structure. They wanted to move into the streaming space, so overnight, the Walt Disney Company became a quote-unquote streaming company. And even while the theme parks and everything else will start generating a bunch of cash and a bunch of operating income and positive cash flows, the only thing that anybody wanted to talk about was, what is the sub growth? How many subscribers do you have? And I have said since I have been on YouTube now a little over a year that I have been lamenting this hyperbolic focus on subscriber count, not just for Disney Plus, but across the board, be it Netflix, be it Paramount Plus, be it HBO Max. At the end of the day, it's fool's gold. Because what really matters is not just the number of subscribers you have, but how profitable are those subscribers. Now, I want to remind everybody that from day one, when Disney Plus was launched, Robert Iger made a projection that said that the Disney Plus subscription service would reach between 230 and 260 million total global subscribers by the end of Disney's fiscal year 2024. Now, as a reminder, the Walt Disney Company's fiscal years run from October 1st to September 30th. So the end of fiscal year 2024 is not December 31st of 24, but September 30th of 2024. So they have about 10 calendar quarters from this moment, from the time this report covered at the end of March 30th, to reach that goal. Currently, they stand a little shy of 140 million subscribers. So any way you shake that number out, in order to reach that goal, they still need a little over 90 million total new subscribers added between now and the time of their goal at the end of fiscal 2024. With just 10 quarters left in the bag, they need to average about 9 million net new sub additions to Disney Plus before that happens. And not only that, and this is where the industry analysts, I think, are finally starting to catch on to what I've been saying for the last year, and that is they're looking at the profitability of this. And that's something that stuck out like a sore thumb in this earnings report, and that is what we really want to talk about. So first, let's look at the actual numbers. In the US and Canada, Disney Plus now stands at 44.4 million total subscribers. Internationally, excluding Disney Plus Hotstar, 43.2 million. So the total of Disney Plus, not including Hotstar, which is the India market, is 87.6 million subs. India, or Disney Hotstar, 50.1 million, a big jump from over 35 million just a year ago in Hotstar. So it shows you where a lot of the big growth is coming from. Total Disney Plus subscribers currently stand at 137.7. And Hulu, ESPN, they're in the mix too, but what most everybody is looking at is Disney Plus. Now, it's also of note that the average revenue per user dropped a little bit domestically, going down to $6.32. It was a little higher in the first quarter of 2022. But we see overall, once you add in that Disney Hotstar, 76 cents average revenue per user, because the costs in India for this service are literally pennies on the dollar compared to virtually everywhere else. But overall, it's at a healthy mark. Now, of course, the Walt Disney Company recently announced on the previous earnings call that they were looking at moving into an advertising-based, lower-priced Disney Plus tier. I said many times in the last year that that would be a foregone conclusion, not only for the Walt Disney Company, but also for Netflix. By the way, what did Netflix recently announce? Why, it's an advertising-based tier. Everybody said I was crazy that Netflix would never do that. Netflix would never get rid of the exclusive premium subscription. Yeah, well, they did it. They did it. I told you they would do it because advertising at the end of the day is one of the best positive cash flow and revenue drivers for any media company out there, bar none. You can't get rid of math. You can't get rid of history. History shows that the results of advertising is always a positive net win for any media company, and with streaming, it was just a matter of time. And I think they're finally all reaching that conclusion, at least from what they have announced, because they and the analysts and the investors are, again, finally catching up to what I've been saying, is that these companies need to be more profitable. These streaming services need to be more profitable. And how did Disney Plus look? Well, compared to a year ago, their streaming revenue went up 23%, but at the same time, their operating losses tripled. Now, I'm frankly glad for this wake-up call because I think this is going to start settling things down overall in the market as more people look at the value of these streaming services versus just purely how many subscribers they have, regardless of how much money they're losing, because that's basically what we've been doing for years now, with the exception of the big juggernauts like Netflix. Now, yeah, Netflix is profitable. They generate positive cash flows, but really not at the margins that I think a lot of analysts and investors would have hoped for at this point. And the other folks out there are starting to catch up to that. This is also why I've been saying Sony was so smart to really not ever engage heavily in the proprietary streaming service game. They figured out that with a movie like Spider-Man No Way Home, they can lease movies like that out to Netflix for a year, probably get $200 million for that contract, and it's instant profit. Versus Disney Plus, that will have run a streaming service for at least 5 years before they see a dime in profit. And that's after spending tens of billions of dollars jumping content onto this thing that they had to produce from scratch. So the revenues for Disney Plus year over year from the same quarter in 2020-21 went from about $4 billion to about $5 billion in total revenue. Sounds great, right? Well, the problem is the operating losses rose from $300 million to $900 million, meaning they lost an additional $600 million, even though they made $1 billion more this year, this quarter, in revenues than they did last year. Now, all of this is attributable to the content spend, the advertising spend, the acquisition costs of getting these new subscribers, building these shows, and the associated technology costs to go along with it. Think of all the additional cloud computing and the server farms and all the additional costs. Every time they add another 1 million subscribers, they have to increase bandwidth and capacity. This is a very expensive endeavor, and like I said, one I think Sony is glad that they stayed out of. So that's the bottom line for Disney right now, and I think that's why the stock price is basically sitting still at this point. It has come down so much from its high. It's lost almost 50% of its value from where it peaked just about a year ago in March of 2021 when it was hovering around $200 a share. And on that note, I want to make this very clear to folks out there. That decline in share price is largely due to two factors. Number one, the S&P 500 itself from November of last year is down almost 20% from its most recent high. And Disney, like any other large cap stock, is going to react fairly accordingly to the S&P. You know the old expression, a rising tide lifts all boats? Well, a falling tide drops them just as much. So that's a big part of Disney's stock price decline. All of the excess beta on top of that, or the additional movement that has happened above and beyond the S&P 500, we can pretty much entirely attribute to two things. Number one, the theme park operation still isn't quite at full capacity. And Bob Chapek on the call has made this known a couple of times. One, in the sense that they have still reduced staffing because of the employment shortage. They can't find enough people to work at the park, so therefore they don't want to open the parks up fully because they don't have the staff to support it. And then they still have problems over the last year, like travel restrictions or parks being outright closed, like Shanghai Disney. Now, one of the things that's going to change, like we said earlier, is those international travelers. That's going to pick things up. But the other thing that's hurting Disney stock is the streaming issue, and the market is still really getting adjusted to this. The Disney stock went up to $200 a share on the hopes, after a year of explosive growth on the streaming service, they thought it was going to radically exceed expectations. Well, all of that has come down to earth. And if you think Disney stock has suffered from the streaming wars, look at Netflix. Their high was $700 a share, and it's now hovering around $160 to $170. If you had to pick between those two, you would have much rather bought Disney at $200 than you would have Netflix at $7. I know a lot of folks out there want to attribute a lot of the Disney stock price debacle to all the wokeology that they have gotten engaged in since the beginning and middle part of March. And while I don't necessarily want to disagree with you, I am going to tell you straight up that the vast majority of Disney's stock price issues right now have absolutely nothing to do with that. That hasn't even been baked in yet. I think if it's going to get baked in, and if it's actually going to impact Disney's bottom line, we're not going to see that until, again, the next earnings report and potentially the last earnings report of the year that will come out sometime in November that will close out fiscal 2022 for Disney. But here's the other side of that equation. Remember, international travelers are not exposed to the same type of news cycles that we are here in the United States. And international travelers, well, those are the ones that Disney really wants. In fact, if the Walt Disney Company could push a button tomorrow and eliminate all domestic business from the parks and replace it for a week with nothing but international travelers, they absolutely would, because the revenues would go off the scale because they spend so much more money. Those folks are not exposed to what's going on in the news here, and those folks are probably still going to show up and come to the Disney parks regardless of how many domestic Disney fans wind up canceling Disney or canceling Disney Plus or canceling Disney Vacations. It very well could have very minimal impact on the bottom line. That's yet to be determined. One thing I did find interesting on the call is that they did project going forward, again, that they felt like the subscriber growth was not going to be as robust in the next quarter as they just reported for this previous quarter of almost 8 million. That could be a telltale sign. You would think if Disney is ramping up programming right now and ramping up content, and the original expectation was that that ramp up of content and programming would boost the number of subs, why then, as this new content and programming is slated to come out, would they project that the rate of growth in subscribers would potentially contract? That's a little curious to me. Now, that's a question that we really can't answer as of yet, and it will be interesting to see where that is going forward, but that's definitely something that we want to keep an eye on. So, hope you enjoyed the video. Let me know what your thoughts are in a comment below. Make sure you hit that like and subscribe button, hit that notification bell, and share this sucker out on the social medias. And until next time, y'all take care.